Hello, this is Stacy Francis of Francis Financial. Francis Financial is a boutique wealth management and financial planning firm dedicated to providing affluent individuals and families personalized financial guidance. Our fee-only approach promises objectivity in our recommendations and services to you. We also provide fiduciary loyalty. That means that our loyalty is to you. We are required by law to put you ahead of our own interests. We are here to give you financial peace of mind. And today we're going to be talking more about one of the most important factors of your financial peace of mind. And that is making sure that your investment portfolio is working hard as possible for you. As a boutique wealth management firm, we provide holistic planning with regards to your portfolio. And with that, you'll see that each portfolio that we create for clients is tailored specifically to them. We believe in diversification. We also believe in reducing your portfolio risk as much as possible. Our investment discipline is based on rational decision-making supported by intensive, deep research. This mitigates sloppy decision-making and, unfortunately, detrimental emotional-based decision errors. Our investment philosophy is that investment portfolios are customized to meet each objective of every single client, that you have access to intensive research and have a disciplined process that's critical to long-term investment success. They believe in global diversification and that this expands our opportunity. And we also believe in a long-term approach that allows us to take advantage of mispriced investments. We offer monthly portfolio appraisals, quarterly performance reports, informed personal letters, discussions about outlook and strategy, and meetings as often as every 4 weeks. Our personal wealth management process helps clients manage their wealth, and it will make your overall life easier. We're constantly monitoring your investment portfolio and are on the advisory board for many well-respected organizations, including CNBC. Other organizations that have given us national recognition include CNN, Forbes, the New York Times, the Wall Street Journal, Barron's, and many, many others. With that, I'd love to get started to dive into the information that we have for you today. We're going to be going through 3 very important areas today. First, we're going to review the market and economic situation. We're going to look at our investment outlook and explain that more to you. And most importantly, we're going to be talking about your portfolio positioning and how that portfolio positioning may change in the coming years. So with this, let's talk a little bit about the review of the fourth quarter 2013. We found signs of U.S. economic improvement, and the accommodative Fed policy helped drive the U.S. large cap stocks to their best showing since 1997, while at the same time, smaller caps actually even soared higher. The story doesn't end there. Developed international stocks also posted very strong returns, much in the U.S. and also across in the Europe. These were boosted by supportive monetary policies, particularly policy that we are seeing in Europe and Japan. Emerging markets, unfortunately, how they suffered a disappointing year, but they roared back in the fourth quarter of 2013. Core bonds suffered their first decline since 1999, over a decade ago. Interest rates rose during the year, and this had a negative impact on the prices of bonds. In fact, we provided for you and put together a wonderful chart so that you can see each of these different asset classes and how they performed not only during the fourth quarter, but how they performed for the entire year. This is another way of looking at that outperformance, or in those items that outperformed during 2013. Here you'll see we have our gray bar charts that represents the fourth quarter performance. You'll see right next to that blue bar charts, which is the year-to-date performance. Essentially, you'll see on this chart that we constructed for you on the right-hand side, all of those asset classes had outperformance in 2013, barring emerging market stocks. We have floating rate loans, high yield bonds, we have US large cap stocks, US small cap stocks, and developed international stocks. That's where we saw the majority of growth in 2013. Now, what about the developed international stocks versus emerging market stocks versus stocks here in the United States? We've gone back to January of the beginning of 2013 to show you where they all began. And over the months, you can see the lowest chart here, the lowest line, this being emerging market stocks. You'll see they had a rough, rocky ride, particularly during the summer. They came roaring back, though, however, December, and are continuing to see an ascent. For developed international stocks, that is more so stocks from Canada, Germany, and the like, here you see that they've had a relatively up time, except for that bout that we talked about in the summer where we saw some losses. They too came roaring back, and that recovery has continued to sustain. Finally, we have our big story. And our big story this year is a story about U.S. stocks. U.S. stocks had a big starting out of the gate in the beginning of the year. Come the middle of the summer, they too felt a drop, but continue to have a very, very steep ascent upwards to where we are now. Now, what I want to talk to you about with this chart is not only where each of these asset classes ended up as of December 31st, 2013. What I want to talk to you about is the journey, the path that we're seeing for each of these markets. Most importantly, what I want to point out is volatility. And you'll see very, very big times of volatility, particularly first area in mid-summer between June and July when it was a lot warmer out. We all think of that fondly, but unfortunately something we forget is that we saw some pretty big market losses during that time period. You'll see other times of volatility right here towards the beginning of September. Then you saw some negatives there, and then some quite steep recoveries right after. Even you can see in the last couple days in the market. In January, we saw some pretty significant volatility towards the end of January 2014. What does this mean for you? What does this mean for your portfolio? It means that we're in a different time, and that is a time where the overall ascent of your portfolio will be up over time. However, the path and the journey that it takes will not be a smooth road. You're going to see bumps and troughs throughout your experience. One day you might be up 1%, the next day you might be down 2%. The next day you might be up 1.5%, and the one after that another 0.5%. But overall, the most important piece to know is that going forward, we expect that the stock market, international developed market, and emerging market stocks will increase over time. And with that, let's talk about the next factor, because this is very important. One of the important pieces is not only having broad asset class diversification, but it's also being smart about the investments you choose. We put together this very detailed table for you to show you your fourth quarter results in performance. We also showed you for 2013 the total return, and we compared it to the benchmark for each one of these individual asset class holdings. As far as the Touchstone Sands Capital Institutional Growth, that had almost a 42% return just in 2013. you obviously were pretty darn happy with that type of return. Now, what happened on the global front? Well, Oakmark Global, for example, for a 34% return just in the last 12 months of 2013. Lazard International posted 25%. Harbor International, almost a 17% return. So with that, you can see that it's important to also have very precise criteria for choosing the right investments, because almost all of our portfolios, all of our investments here, you can see outperformed their benchmark. Touchstone Sands outperformed by more than 8%. Harbor Capital Appreciation outperformed by more than 4.5%. Oakmark Select, 4.46%. The story even gets more exciting. Oakmark Global had an outperformance of 13%. Lazard International, outperformance of 9.97%. This is amazing. Barron Emerging Market Fund, outperformance of nearly 20%. So again, what we consider when we're looking at our detailed investment criteria for making changes to our portfolio, adding to our portfolio, or maintaining our portfolio, it's not only having diversification and asset class exposure, it's also making sure that we're choosing the best investments we can within the arena, the universe that's available to us. From a historical perspective, the decline in bonds was actually quite rare. As I had mentioned, we had not seen losses in aggregate bonds, U.S. aggregate bonds, all the way back. We have to go back over a decade, back to 1999. Yes, that was the time of Madonna, not to date myself, and a few others. But life has changed quite a bit then. Before that, we had to go back to 1994. And you can see in this chart, we had no negative results for the aggregate bond index going all the way back to 1976. We put it as far as we could, but unfortunately, we couldn't get as much data as we'd like to go even further back. But what's important for you to know about this is that this is an anomaly. It's an anomaly, but it's something that is very important for your portfolio. And that is because we expect losses in bonds in 2014. So we could be making history, yes, 2 years in a row. So what are we doing about this? We have bonds in almost all of our portfolios. You need bonds for a diversified portfolio. So what do you do? What do you do when you know that there is an asset class that most likely is going to see losses in the next year? Well, what you do is you get creative. And that's exactly what we've done. So I want to show you this chart. We have the Vanguard Bond Market Index at the very top. Now, this is the index that we're going to be comparing ourselves to. We are not currently invested in this. But it's important for you to keep this in mind when we go through the individual holdings that we have here in our portfolios. So the first you'll see, we have the double line total return and PIMCO total return. These are the bond funds that most mirror the holdings of the Vanguard Bond Market Index. They are similar to high quality corporates. They are most similarly invested to the aggregate bond index. So here you'll see that for 2013, the double line total return was actually mildly positive. It outperformed the Vanguard Bond Market Index by over 2%, which is quite a bit to say, particularly for bonds. Now, the PIMCO total return had a slight loss. We weren't surprised about that because of its holdings. However, it still outperformed our index by a mild degree. The exciting story is where we go with regards to flexible and absolute return-oriented bonds. These may not be terms that you've heard before, but I'm going to give you an insight into what they really are. That way you go to your next cocktail party, you start talking about interest rates and losing money in bonds, you'll have some really smart tips to give people in explaining what they need to do about their bond portfolio. Absolute and flexible oriented funds are funds that the manager has more flexibility in the way that they invest. And so within here, you'll see that the investments are in funds that are less sensitive to interest rates. That is, bonds that are less sensitive to interest rates. And which bonds are those? The bonds less sensitive to interest rates are short-term bonds, floating rate bonds, emerging market local bonds, high yield bonds. These are the few of the bonds that give you that same diversification, that security, create a cushioning to your portfolio, act as trying to reduce risk in your portfolio, but are not as negatively impacted as interest rates rise. As interest rates rise, bond prices go down. That's how you lose money. And again, that's why you want to make sure that you're very careful and you invest in types of bonds that are not going to lose money over the next year as interest rates rise. So you'll see here we've got interesting, unbelievable outperformance. The Loomis Sales Bond in Fund, 8.14%. Osterweiss, over 8, almost 9% outperformance. That is huge. That is huge. Again, remember, we're talking about bond funds here. We're not talking about risky equities. We're talking about bond funds. So that level of outperformance is quite wonderful. Why is this important? Well, it's important for us because you need to have a exposure to bonds. Every portfolio should have some type of exposure, and it's different for every person. It may only be 20% of the portfolio. Others, it could be actually as high as 60%, some even 80% for that unbelievably conservative investor. We need to make sure that we don't lose money. Another way that we're able to do that is investing in floating rate bond funds. Now, floating rate loans are wonderful because as interest rates rise, the rate on these bonds also rises, essentially protecting the portfolio. You can see that the outperformance here versus the Vanguard Bond Market Index is quite substantial. We have for the DWS floating rate, which I love, a 7.4% outperformance. And we have the T. Rowe Price institutional floating rate, an outperformance of 7.39%. This is a really important story for you. And actually, we put together this chart to show you visually the sensitivity of these investments to interest rates. The more sensitive the investment, such as the PIMCO total return, the more likely you are to see losses when interest rates rise. The biggest takeaway I want you to note is that most of our allocation is on this side, a sensitivity of anywhere between 0 and 1 and 1 and 2. The majority of our holdings are not sensitive to interest rates. We only have 3 holdings here, the Double Line, Loomis Sales, and PIMCO, that are more sensitive. We've also included for you the Vanguard Bond Market Index, just to show you again as a placeholder where that lays, and the sensitivity, it's almost bordering on a 6 versus the holdings that we have. This has been one of the biggest changes that we have made over the last year. And it was something that took us quite a bit of work to implement in every portfolio. But you can see that we've benefited handsomely from this, and we also expect to do so over 2014. Overall, we're quite excited about 2014. We've seen improving economic outlook in most major parts of the economy. The growth rate for the global economy improved year over year, and it also seems set to increase at least moderately, if not better, in 2014. On a year-over-year basis, the U.S. economy grew at a real rate of actually about 2%, much better than many of us had thought. Europe finally emerged out of the recession officially, and the UK and Japan also generated modest but positive growth. Overall, emerging markets growth was disappointing in 2013. You saw that in the beginning of the year as an impact, particularly during the summer, on the emerging market performance. However, it is well positioned, very well positioned to have great performance from improved export demand going to the developed markets next year. Again, remembering that the economy is a global economy. When we see the US recovering, we see developed international, such as the UK and Japan, also improving. That immediately has an impact on the emerging market countries because the biggest importers of emerging market products and manufacturing is, yes, you're right, the US and also developed international economies. So we expect to see for 2014 additional growth in emerging markets, specifically because we are going to be seeing more demand. Talking about manufacturing, it's a perfect segue into this. When we look at the JP Morgan Global Manufacturing and Services PMI, it tells us another story of positive, improved economic conditions. Here you'll see at line 50, at PMI levels greater than 50, and what we've done to make this clear for you in this chart, we have a red line signifying that magic level of 50. Any PMI levels greater than 50 signify that there's an economic expansion. Any figures below 50 signify a contraction, going back to our macroeconomics 101 in college. So where are we at right now? Well, right here you see this massive dip. And if anything, to be honest, we probably didn't have to put the years at the bottom of this chart. You would have known very clearly that was 2008 going into 2009. But the story you see afterwards is quite an exciting story. You'll see that the PMI levels have shot up, and more recently, you start to see some continued growth upwards. This is a definite positive booster. The global manufacturing and services activity, it indicates that we are in a economic expansion. This is an economic expansion that we expect for 2014 as well. The surging U.S. stock market and housing prices rebound have boosted household net worth, actually to new highs. If you look at this chart, you'll see household net worth a little over $20 billion. This is going back to 1990. Where we're at right now, we're bordering on reaching almost $80 billion. So quite significant with regards to overall household net worth. The housing market has continued to improve. For example, the factor that we look at for seeing household improvement, we look at the S&P Case-Shiller Home Price Index. And this was actually up 11% from the year earlier, 11% from 2012 to 2013. We also have another figure. We use the data firm CoreLogix. We look at their reports, and what we've seen is that the percentage of homeowners who own more of their home's worth, who owe more on their homes, that is their mortgage is greater than the value of their home, fell to only 13% compared to 22% a year ago, nearly halved during that 1 year time period. So overall, household net worth has surpassed the pre-crisis high of $77,259 per household. And with that, it's quite significant to the overall financial situation that the average consumer finds themselves dealing with. This also has been boosted by the labor market because the labor market continues to gradually improve. In fact, non-farm payrolls, which is the net new jobs created in the economy each month, has averaged a very solid rate of nearly 200,000 per month in 2013. During this time, we also saw the unemployment rate drop to only 6.7% in December. Now, before you get too excited, you put your party hat on, it's important to put this in context. Much of this decline has been due to the drop in labor force participation. The labor force participation rate is actually at 30-year lows at this time. We've seen two big, very strong trends. The first trend are those people who have been looking for jobs who have essentially dropped out of the looking for work labor force. They have decided to no longer participate and have thrown their hands up. We have a second group of individuals, and those are folks that are deciding to retire. They've been let go and they are taking early retirement. You may be one of these people. You may know many friends who are in this situation. People who have been downsized, who have not been able to get back in. They could be in their late 50s, 60s, or late 70s, or late 60s, and they are having a very big challenge getting back into the labor force, and so as such are retiring early. Now, jobless claims are also trending better. Jobless claims are below their long-term average, and they're trending lower. So here we have a wonderful chart that we put together for you. It shows you the 4-week average of initial jobless claims. We go all the way back to 1965. What's interesting about this chart, this is another situation where I feel like we didn't really have to put the years at the bottom of this table, at the bottom of this chart, because you can see very clearly where 2008 occurred in 2009. And the positive is you'll see that the jobless claims are trending lower since that time period, which is a much better and much healthier sign for the economy. Now, what are people being paid? We're seeing lower unemployment. We're also seeing trending lower of jobless claims. What is the amount that people are earning on an hourly basis? This is a concern we have. We are seeing subpar wage growth, and this implies that there's going to be subdued consumer spending. Wage and income growth in the U.S. remain subpar, although the positive is they've increased a little bit since late 2012. And you can see this positive trending upwards slowly since 2012. But more importantly, we really want you to take this into consideration to the past years, the past decades. If you look back to 1965, 70, 75, you see much higher average hourly earnings per employee. So we've got quite a bit of ways to go. This weak income growth implies that, unfortunately, consumer spending is likely to be subdued. Even though that consumer has higher net worth, many more people are actually employed than previous years. But again, it's somewhat of a headwind. Why is this important? Well, it's quite significant because consumption from the average consumer, you and I, and what we buy, it accounts for roughly 70% of GDP, which is how we measure the overall growth of the United States economy. This suggests that there's going to continue to be a drag on economic growth. Now, this is absent any increases in consumer borrowing or reduced savings. If we see more consumer borrowing, or if we see reduced savings from the average consumer, what that means is that money is going to be available then for them to spend. That is the one unknown that we're not sure about that could possibly make this story look better than what we're seeing right here. Household financial obligations are at a historic low, and this is thanks to low interest rates. As interest rates have been reduced significantly, individuals like you and I have been able to make much bigger gains on paying down our debt, whether that was credit card debt, payday loans, mortgage debt, an improved debt and credit picture, it bodes well for consumer spending. People have more disposable income that is not going towards paying off debt. It's not going to servicing debt. Instead, it's available for spending for household consumption. So as far as where we're at, we're quite happy because we're seeing that where we're at versus 2007, 2008, we're at a much more sustainable debt level. And as credit conditions continue to improve, we expect that this situation will also continue to improve. The Federal Reserve balance sheet as a percent of GDP, unfortunately, this tells you a different story. The Fed policy, particularly regarding spending and debt, it remains a long-term challenge. And unfortunately, this is a long-term challenge that impacts you, that impacts your kids, that impacts your neighbors and your colleagues. Why? Well, the Fed's balance sheet is now more than 22% of GDP. This is a extremely large percentage. And how you know that is we added for you, going back all the way to 2003, to see historically the balance sheet as a percentage of GDP. Going back to 2007, early 2008, you were at below 6%. Now we are at 22%. It's unsustainable. It's high and it's unsustainable. The U.S. debt level remains very high, and the projected growth in government debt is actually too high to be sustainable over the long term. The biggest challenge we have is getting our government debt situation back on track and resolving this without causing a deep, profound, severe economic contraction. It's going to be challenging. It's going to be challenging even in a normal growth environment. So based on this is, again, what we consider a headwind for us going into the next couple years. It's not going away, and it's going to continue to be a topic that you see on CNN and CNBC, a topic that you see at reading at the top of newspapers. The debt situation is definitely improving. However, we have a long way to go. Let's talk a little bit about our broad economic scenarios. Here at Francis Financial and with our research partners, Littman Gregory, we run many different models. And these models give us insight into the type of recovery we're currently experiencing and the type of recovery that we'll have over the next several years. Right now, where we are is a subpar recovery. You'll see that if we have a more optimistic view, and also if the economy recovers more quickly, we see even stronger economic fundamentals, not only here in the United States, but just as important globally, we could be moving even to an average recovery, which is what we'd really all like to see. Now, we put this chart together for you. I know there are lots of numbers. There's lots of information on here, and it can be a little bit overwhelming. Let me tell you what this is, and we're going to step through it step by step. This shows you the asset class returns for our current portfolios. The bold horizontal lines you'll see in the chart indicate our return estimates for our base case scenario, and that is that subpar recovery of which we just spoke. The high and the low of each of these asset class bars It represents the best and worst case scenario moving forward over the next 5 years. This is again showing you the 5-year asset class return estimates for each of these different categories. So let's take US stocks, because I think this is an interesting story. Here you'll see our base case 5-year return estimate. Nothing too exciting, bordering on about 2%. This is if we have an average recovery. If we move something, this is for a subpar recovery. I apologize. That is for a subpar recovery, what we are currently experiencing. However, if we have just an average recovery, you can see it bumps up to almost 11% return. A couple things to note about this. The first is that we're leaning towards the next several years that we will be moving from a subpar recovery to an average. That bodes very good news, as you can see clearly by the potential performance of US stocks. The second piece to take away from this that's really important for you to realize is the very, very large difference in return expectations. So you'll see that there are extremes. There are extremes from 11% returns to, quite frankly, possible negative returns around the 8% level. This is again over a 5-year time period. Our portfolio position, it seeks to balance these extremes. It seeks to reduce risk. And what we've done is we've created our portfolio to take advantage of a subpar recovery. As we start to see stronger economic fundamentals, that's when there's the opportunity for us to tweak that portfolio and add more, particularly US stock exposure, potentially more international stock exposure, to add more return over the next 5 years. Let's take a look at why we're finding the US stock market in that subpar recovery only expecting about a 2% return. Well, this is an interesting story. US stocks are positioned and trading at what we see as almost nosebleed levels. How do we know this? Well, there are many reasons, but this is one reason for why we believe that. In this chart, we've gone back to data all the way back to December 31st, 2009. We've showed you the trailing 12-month earnings per share. We've also shown you the S&P 500 index and the performance of the S&P 500, and it shows you exactly the levels where the S&P 500 traded. What's interesting is that the relationship between 12-month earnings per share and the relationship with the S&P 500 index performance is quite similar. You'll see that they roughly are coupled together. But however, what has happened since December 2012 and through all of 2013, we have seen a decoupling. It makes it harder for us to see large gains in this S&P 500 going forward when we have had so much growth. Where are these gains going to come from? These gains are going to come from increased earnings per share for corporate profits. It's going to come from a continually improving unemployment and labor wage picture. It's going to come from a rebound in manufacturing, many of the important industries such as real estate. It's also going to come from overall global growth. So essentially, this is the story about where we are now. We're in a good position, but moving upwards, we don't expect the same types of returns that we saw in the S&P 500 for 2013 as what we expect over the next 5 years. Now, emerging markets, they tell us a different story. Here we have our higher nosebleed levels for US stocks. We've got fair, moderate levels for European stocks. And then this is the real story, our emerging market stocks. We think that emerging markets 2013 performance trends were really a very large overreaction to shorter term factors that do not have an impact on the longer term. We continue to view emerging markets as likely to generate much higher returns than the US stock market across most scenarios, both the subpar recovery as well as the average recovery. This higher return potential that we see in emerging market stocks, it's a function of a few things. And one of them is that it has more attractive valuations. We're trading at much lower levels, much easier to see that growth. We also expect there to be stronger earnings growth from emerging market countries in the next 5 years. We continue to view the downside risk and volatility of emerging market stocks as higher than US stocks. So we take this into account for our overall portfolio construction. Some of the questions you may have is, if the story is to put is more of a play on emerging market stocks, why are we not overweighting to emerging market stocks? The answer is actually, for almost all of our portfolios, yes, we are. Yes, we are. However, for every portfolio, we have a risk loss threshold. That risk loss threshold is a 5% number, a 10% number, a 15% number. It's a number that we should not, a potential loss that anyone could have in any 12-month period. So if your portfolio has a risk loss threshold of 5%, that means that in any 12-month period, your portfolio, that's knock on wood, your portfolio should lose no more than 5% in that 12-month period. Now, just to make sure, we have the disclaimers going back to 1970 that has been true. However, there have been time periods when that is not true. The most important time period when that did not occur, that we lost more than that, was from February 2008 through February 2009. But we are very careful when we create those portfolios, when we construct those portfolios, that when we add risk, when we add more exposure to emerging market stocks, that we make sure that at no point do we violate that rule of adding so much risk that the risk loss threshold for you goes up. Because we've made an agreement. We've created this in your investment policy statement. We are committed to that. You're committed to that. And so we stand by that. We will not be swayed by hot investment options. We will take advantage of them, but we will not let that in any way violate our commitment to your portfolio growth potential and your portfolio risk profile. China is the biggest country we think of, the biggest economy that we think of when we talk about emerging markets. Here is a very interesting opportunity because the Chinese stock market is roughly 15% down from its early February 2013 highs. And it's down 8% from the beginning of 2013. So I take that back. Sorry, February 2013, it's been down 15%. From the beginning of January, it's down 8%. What this allows us is it allows us to be in a position where the Shanghai Composite Index is very fairly priced. And we have this in our portfolio, a small piece of it in our emerging market investments. And it's something that you'll see some really big returns from. So how are we positioned? What is the rationale behind this? We've put together this beautiful chart for you to show you for our fixed income, our equities, and our alternative investments and how we are allocated. That traditional investment grade income exposure, we are under allocated. Do you remember the Vanguard Bond Index that we went through previously in the presentation? We are under allocated to that type of an investment of traditional investment grade bonds because we know that they are sensitive to interest rates. As interest rates rise, that is where we're going to see prices drop. We're going to see losses there. Absolute return oriented or flexible bonds, we are over allocated. These are flexible strategies that can perform well even with interest rates rising. Floating rate loans, we have floating rate loans in many of our portfolios. It protects from rising interest rates and it gives a little bit more boost for higher return. We have emerging market local currency bonds. These are over allocated. They have very attractive potential returns from emerging market countries, and they have much, much, much less risk than emerging market stocks. So let's talk about the stock allocation here. Larger cap US stocks. We're under allocated. Right now, equities appear overvalued. And unfortunately, the potential returns, unless we move from a subpar to an average recovery, seem low. Smaller cap stocks, it's the same situation with them, under allocated. And again, similar to large cap, more downside in poor economic conditions. Foreign stocks in developed markets, we are neutral. They're moderately attractive and they offer a broader opportunity set and diversification benefits. So we do have a good amount that is in developed markets. The real story here, foreign stocks, emerging markets, we're overly allocated. These are attractive relative to the US, both on a risk-adjusted basis, but also on a reward basis. We expect much higher returns from emerging markets. And alternative investments. We are over allocated with alternative investments. This is a risk, it has very, very attractive risk-adjusted returns. These investments also have low correlation to stocks and bonds. Bringing back to what does that mean? Low correlation. Low correlation means that if one investment's going up, the other one shouldn't be impacted. Low correlation means that if investment's going down, the other should not be impacted. You want asset classes that are not always correlated. Why? Because 2008. You know how that felt. Equities lost value. International equities lost value. You saw very severe and in some cases painful losses. Well, not our clients. Why? Because we had a good amount of exposure to fixed income. We also had a good amount of exposure to alternative investments. Just so you understand what our positioning in alternative investments is, it is in investments that you can get your money back within the next day. You are not tied up into a hedge fund for a couple years or a private equity investment that you can't get your money out of. This is really important. And it's really important for you to know for your overall comfort and your overall peace of mind. So in conclusion, the positive is that the global economic fundamentals are gradually, continually improving. We've seen this over the past year across many different dimensions that I talked to you about today. And we seem poised for continued improvement for at least into 2014 and beyond. Unfortunately, there are risks still out there. We talked about excessive global debt, excessive debt here in the United States, subpar growth, and a policy that we continue to worry about. The range of possible outcomes with regards to asset class returns remains unusually wide. What we ask is from you of patience, of maintaining that long-term perspective. It's even more important now because the volatility, the ups and downs of the market, that's the new norm. And if you're watching your portfolio every day, it's going to create a whole lot of anxiety. It's more important to think about the long run. And over the long run, your portfolio will perform well. We don't know timing, but we are confident that there are some better investment opportunities that are going to rise over the next couple of years. They're right around the corner. And we have some dry powder. This dry powder is in the form of what we call lower risk investments, such as fixed income and these alternative investments. It's going to be a major benefit for us when these opportunities arise. Such opportunities could be a very big loss in the S&P 500. That would be a great opportunity when we see a very big loss, sustained loss, to be able to jump in and buy at some much more attractive valuations with regards to U.S. domestic equities. Emerging market stocks are likely to generate much, much higher returns than U.S. stocks across almost all of our scenarios that we look at. And our exposure to this class is actually quite significant. It's overweighted. It's going to give us a boost in the performance over the next 5 years, which we're very, very excited about. So with that, I want to say thank you for your time. Thank you for your trust. Thank you for your confidence. If you know of a dear friend, a family member, a loved one, a colleague that could benefit from the peace of mind that Francis Financial offers with ongoing investment reviews, comprehensive and personalized financial planning for them, please let us know. We love our clients. We get to work with the best clients out there. Clients that you're happy to spend your Saturday having a Starbucks coffee with in Starbucks. We're really, really blessed. We thank you for that. We want to work with more clients like that. You make our jobs why we love our job. And I will tell you, I am passionate about my job. I adore what I do every day. And I feel so unbelievably blessed. So blessed that I have this amazing company, that we have such an amazing, talented team here. And most importantly, that we get to work with people like you. So thank you. Thank you for making our jobs, well, not a job. And thank you for thinking of us. And please let us know if we can help anyone else. That's why we do what we do. Reach out to me, Stacy Francis, at Stacy, S-T-A-C-Y, at francisfinancial.com. Please also visit our website, Francis Financial, at www.francisfinancial.com. There's a wealth of information about how we can help individuals, and you can also see a lot of our recent press. We're profiled in the press typically 5, 6, 7, even 8 times a week. Today it was just the Huffington Post. Yesterday it was CNBC. We're profiled because we're fee only, because we're independent, because we're fiduciaries, and because we do a great job for our clients. Thank you. Have a great year, and know that we are here for you.